Good morning.
Morning, James.
We can hear you all right. That's fantastic. Thank you. So you've got a presentation that you kindly gave me. I think best to hand over to you for a bit and just sort of run us through what the fund is and what it's trying to do, please.
Thanks, James. And Andrew, thank you very much for that very interesting overview of the investment trust sector. There's a disclosure. I don't think we need that. People can read that at their leisure. So thank you, Andrew, for that overview of the investment trust sector. My name's Stephen Marshall. I'm chairman of Cordiant Digital Infrastructure Fund. That is a fund that was an investment trust that was set up in February 2021. So it's a fairly recent development. We've now just announced our second annual report and accounts, and I will over the next few minutes take you through the performance of this business and who we are. But prior to setting up this fund, I'm not a banker, I'm not a financier. In fact, my career has been as a multinational corporation executive, running larger and larger companies through my career, ending up as president of American Tower Corporation, listed on the New York Stock Exchange with a market capitalization of just under $100 billion US dollars, the biggest REIT in the world and the biggest telecommunication tower company in the world. And I've been in digital infrastructure now for over 25 years. So 3 years ago, Cordiant, who are a private wealth manager out of Montreal, and myself decided to work together to try and set up an investment trust that would actually give retail investors the opportunity to invest in this really quite exciting sector of digital infrastructure. And that's defined as telecommunication towers, fiber optic networks, and data centers. And we successfully launched this investment trust, as I said, in February 2021, on the back of my reputation and that of Cordiant as an institutional investor. And we've invested, we committed to investing in digital infrastructure, towers, fiber, or data centers in UK, Europe, or North America, so OECD countries, and in the middle market. So assets primarily private, or I guess wholly private assets, where we would have control of those businesses. We would manage those businesses effectively, in order to try and drive a greater than 9% internal rate of return for investors over the medium term, and that's what we've certainly achieved in the last 2 years. In the last 12 months, we showed a 10% total return, which drove the net asset value per share to 113.4 pence, having listed, of course, at 100p. So good growth in the net asset value per share, and that's despite increasing our discount rate, our weighted average cost of capital, by 81 basis points, primarily based on a read across from comparables in terms of increase in debt rates, increase in beta risk, etc. So despite increasing the discount rate, we were still able to further increase the net asset value of the shares. We set out in the prospectus that we wanted to not only invest in digital infrastructure, but we wanted to invest in a way which was pursuing a buy, build, and grow strategy. So not coupon clipping, taking all of the yield out of the investments that we make and passing that back to shareholders, but rather passing back, a reasonable yield, and then reinvesting remaining cash flows in organic growth within the operating businesses, maybe small bolt-on acquisitions, and indeed, as we raise more equity, potentially more larger assets that would add to wider portfolio diversification. So in the prospectus, we said in year 1 we would pay 1p dividend, in year 2 we would pay 2p dividend. But actually in year 2, because of the quality assets that we were able to secure, the board did actually commit to paying a 4p dividend in the second year, We paid 3p in the first year, 4p in the second year, so well ahead of expectations, and in line with what we're trying to achieve, which is sort of under promise and somewhat over deliver. And within our short window of operations, we've been able to primarily do that. And the dividend of 4p is well covered. The normal metric you might see is it's covered by EBITDA. In our instance, it would be covered 3.4 times by EBITDA. But if you take away from EBITDA interest costs, which obviously you have to pay if you've got debt in the business, operating expenses, you get to an adjusted funds from operation, which is really pure cash flow that's coming out of the business, and that pure cash flow would cover the dividend 1.5 times. So very, very well covered. And you can see there on the right hand side of this particular slide, we are aiming to beat that target return of 9%. We've got 10% in the last year, and we've got 21.1% since inception of this particular fund. So good progress. We move to the next slide. This gives you an idea of just how the fund has evolved over the last 2 years. In February, we made an initial raise of £380 million. We quickly came out having found CRA, which is a big multi-asset tower, fiber, and data center portfolio, national champion in the Czech Republic. Having acquired that, we came out with a further raise, and ultimately a third raise, and raised a total of £800 million over the 3 raises. Because we acquired CRA, really great performing asset, we were able to offer that 3p dividend. Then in January 2022, we reached agreement to acquire Hudson Interexchange, which is a data center business at 60 Hudson in Manhattan. And 60 Hudson is probably the most interconnected building in the world. And people want to access, data center facilities in that building because they want to connect to, a subsector of the 300 other people that have their servers in that building. So we acquired that at very, very advantageous terms. We then increased the dividend to 4p on the basis that we had reached agreement to buy Emitel, another really strong cash flow generating business, again with large towers that support the national broadcasters in Poland, smaller towers that support the mobile operators in Poland, and certain fiber connectivity assets that can provide sort of service and support to both of those customers and government entities. We raised a couple of €100 million of Eurobond to add to our funding capability, so that we could add further diversified assets to the portfolio. And very recently, in the last 6 weeks, we notified the market that we'd acquired American Towers business in Poland, which was a fairly small portfolio of telecommunication towers. We still have £250 million of liquidity. Some of it is held on the OpCo balance sheet, some of it is held at the HoldCo, and that is available to spend on further diversification of the portfolio. If we move to the next slide, this across all of the 3 assets gives you an indication of the level of diversification of the asset mix. And we own these companies, all of these companies outright, but across the companies, there are over 1,200 telecommunication towers. There are 60 very, very tall towers that are used to service and support the primary broadcasters in both Poland and the Czech Republic. The equivalent of the Polish and the Czech equivalent of the BBC, ITV, Channel 4, Sky, some international broadcasters that are making their content available within these countries. We have a number of data center, particularly data centers that support edge data facilities, and you're going to hear a lot more about edge data facilities over the next decade. I guess many of you have heard of hyperscalers. They're remote to the end user quite often. You have fiber optic cable that allows you to access data in those facilities, but they are environmentally really quite challenged. And therefore, what's happening and what will increasingly happen is we will start to hold topical data very close to the end customer, and we own a number of smaller data centers close to the population centers that can be tethered to hyperscalers, and that is quite a rapidly emerging data center opportunity. We have over 4,000 kilometers of fiber optic networks that supports broadcast and mobile operators. We have tens of thousands of Internet of Things sensors, and I guess the best way to describe that is probably your water, gas, electricity meters. Many of you, I'm sure, will have smart meters that can be read remotely by the utility companies. Nobody has to come and knock on your door now to check the reading, and those are actually read over an Internet of Things network. So we have those networks in Poland and Czech Republic. We're increasingly providing access to the utility companies to read meters, but also all sorts of other sensors that you might find that are deployed in smart cities for environmental monitoring, weather monitoring, etc., can all sort of work across an IoT network. So, a new emerging, growing proposition on both of those national networks. If we move to the next slide, I can say a little bit more about each of the wholly owned investments that we have. Emitel in Poland is our biggest investment. As I've said before, it is national champion. It is the #1 provider of this type of infrastructure across Poland. It's seen as critical infrastructure, absolutely crucial for the broadcasters to be able to deliver their signal, the broadcast channels to the population. CRA, the same, national champion again in the Czech Republic, providing infrastructure for the broadcasters, and both of these providing infrastructure to the mobile operators to deliver the mobile network service. Both of these companies have good, solid growth opportunities. They can build more mid-sized towers in order to support the mobile operators where they don't have coverage for the mobile service, or where they need to install antennas because they don't have enough capacity. And we all suffer from that in the UK. We have a very flimsy network here in the UK, difficult to access data sometimes. The speed of download of data is poor sometimes, and that's due to lack of capacity on the network. So very much a growing market for both of these businesses as mobile operators find more cash to put more antennas onto this infrastructure to add more capacity and to provide better support for customers. And these two economies, Emitel in Poland and CRA in the Czech Republic, doing better in many respects than perhaps some of the Western European economies. If you look at the Czech Republic, GDP growth last year was 2.5%, and we see that Germany is in technical recession at the moment. So driven by much better inward foreign direct investments, good growth in operations in these countries, and Poland, a wall of cash going into Poland in support of the refugee crisis. Monies and investment going into Poland to add further security to our forward base, against for NATO. So good, really growth economies, and great sectors in terms of digital infrastructure with the wind at our backs, with everybody wanting more capacity for digital infrastructure. And finally, Hudson Interexchange in Manhattan, in New York. That is a growth opportunity. It's not cash generating at the moment, but as we lease up the floors, as big corporates, banks, media companies, Google, Facebook, want access to that facility to co-locate and have low latency connections to all sorts of other banks and media companies. we will see good growth from that particular asset over the next few years. So we go to the next slide. What I'm trying to show here is digital infrastructure is very much a growth business. It's almost intuitive. I'm sure many of you will recognize that you are taking more and more demand off the network, whether it's over your mobile network or whether it's downloading through your laptops with your fiber optic connections. And as a result, digital infrastructure investment is probably the third largest sector for investment today. And certainly historically, we've seen the demand for more and more capacity growing at 30-40% a year for many years. And okay, this graph stops at 2022, but there are a number of pundits out there forecasting that demand across the network, because of just general usage, more applications, AI now coming into the forefront, will drive even more demand for data center capacity, even more demand across mobile telecom networks and fiber optic cables, and more demand for physical infrastructure for antennas on towers. So very much wind at the back, growing at a double-digit rate, which is very helpful if you're in that business. If we go to the next slide, I would just sum up by saying that despite it only being in existence for a couple of years, I think the thesis is really playing out now. The assets that we've acquired are operating extremely well. These are very, very important assets in the countries in which they operate, and they're driving very, very good growth, very, very good EBITDA, very good cash flows. 10% return over the last year, 21% return over the last 2 years, beating that 9% target hurdle rate that we set out in the prospectus. Dividend well covered. A very diversified portfolio mix, and I know that people in investment trusts would like to see multiple different legal entities. We have 3 actually across these assets, but within those legal entities there is a massive diversification of assets, some of which could be sold off, either one or a portfolio of towers or fiber optics or the data centers. So there is a high level of diversification if we wish to pursue that, the sale of any of those assets. Strong liquidity, opportunities to drive this thesis of buy, build and grow, buy good assets with good management teams, encourage them to invest in organic growth, encourage them to invest in bolt-on acquisitions, yet still have enough cash to pay a dividend for the investment trust sector. And with that 250 million of cash that we have today, we do have 2 really good opportunities that are actually today under exclusivity that we're now undertaking confirmatory due diligence on, and in reality we could choose to close on one or both of those in the next sort of couple of months to further diversify the asset base. And those 2 assets under exclusivity are Western Europe, and they are in, I guess, different segments of digital infrastructure than the assets that we have in Poland and the Czech Republic. So with that, James, I'm certainly happy to try and answer any questions that listeners might have.
Thank you very much, Steve. It's quite a good rundown.